All right. I mean, when you hear the man himself, doesn't sound too dovish, does he? But market interpretation, of course, was dovish, and they did rally. Steve Brice is Chief Investment Officer at Standard Chartered Wealth Management. He's joining us now. Steve, great to have you with us here. You know, so the markets have rallied, a dovish interpretation, but is there a risk at all that, the next session, markets are going to wake up and say, well, hey, it was not that dovish. It was status quo. So there's no reason to be joyful about. What's your sense, Steve?
So I guess obviously people are very focused at the moment on that 50 basis points implicit reading for the December FOMC. We do obviously have inflation numbers and also an employment report to come out before that Fed meeting. So we still have two data points that could swing us either way. Of course, it could swing us towards saying 50 basis points and not as high as markets are expecting next year, or it could swing us back to 75 basis points and a lot more. So the data is still going to be pretty important. We did have the latest labour market data, which did suggest a softening in hiring as well. I think that shouldn't be underplayed in this conversation. The Fed knows they need to slow the labour market to achieve its objectives, and the signs that might start coming through in the coming weeks and months. So I think that's the positioning at the moment. So 5% terminal Fed rate still seems there or thereabouts, I think. So that's what markets are pricing. But markets obviously at the moment very focused on the dovish read. But as you say, I think rates higher and for longer, or still higher and for longer, I think is still a challenging environment for equities.
Steve, morning. What is it that exactly positively surprised the street? Pre-Powell, the indices were absolutely flat. In fact, mildly in the red as well. And post the speech, you saw them rocket to gains of about 2 to 4%. Markets were anyway anticipating a step down. That the December policy meeting, we are going to see a 50 basis points rate hike and not 75 basis. So what is it that exactly positively surprised the street? And if we actually do get a 50 basis points rate hike, do you think there is an element of surprise still left? Can the markets continue to climb higher? What's the positioning like?
So I think actually that last point that you raised is probably why markets did well. It's more relief rather than the change in expectation. It sort of confirms what people thought was probably likely to happen anyway. So if you look at the equity market positioning has been very light. It's obviously been building in the past couple of months, but it has been very light. So it's just took less negative news to induce this rally. I think we're at really important levels today for the S&P. So if you look at the downward channel since the beginning of the year, we're right at the top end of that downward channel now. So we've done the easy rally. The question now as we move into 2023 will be, okay, we've seen valuations come down sharply this year, earnings still grow. Obviously, this has allowed valuations to move back up, but we do think that earnings are likely to surprise on the downsides. The consensus is 5% earnings growth. If we get the recession we expect, that's probably very significantly too bullish. So we could see those earnings expectations come down. So for now, we're still in a downtrend. We're at the top of that downtrend. We have concerns about earnings outlook. So we wouldn't be chasing this rally today, but obviously watching things very closely.
Okay. Hi, Steve. The last time as well, you said that you won't be allocating any fresh money to equities, given the kind of valuations that we have and the headwinds that are placed with 2023 in mind as well. Does this still qualify as a bear market pullback rally? Or do you believe we're getting into that bullish stance now?
I think because we're still in that downtrend, and we are clinging on to that downtrend by the skin of our teeth at the moment, it still looks like a bear market rally. Of course, if we were to break out of that downtrend, then that would change the picture quite significantly from a technical perspective. The fundamental picture, we're still not convinced is positive. The only thing I would say is that would build the bull case, which is obviously not the side we're on at the moment. But if you look in history over the past 150 years, when you've had a very sharp downturn in a calendar year, usually over the next year, equities bounce. The only exception to that is 1931, where 1932 was also a down year. But every other year that we've seen, declines in the magnitude of what we've seen this time, we've seen a strong bounce in equities the year after. So even if we do get that recession, maybe that's a front-loaded weakness in the equity market. We see a much stronger second half, but the timing is very difficult to judge.
Steve, just a quick sort of take from you on what's the signaling effect of oil going to be? Oil is falling and falling sharply. Yesterday it gave out an important monthly technical signal, bearish, with bearish implications. A bearish outside month. The last two times it happened, in 2020 and 2018, this was accompanied by sharp fall in equity prices and a sharp rise in the US dollar. Do you think it's a different kind of place we are in right now, or the same could follow this time as well?
Obviously, it's not coincident, as you indicated, but I think the question is really, are lower oil prices a good indicator, because they're obviously a loosening of global financial conditions? We obviously see that from an India market perspective as being really important as well, but it's also a global phenomenon. So from that perspective, lower oil prices are a positive, or is it a sign of weak demand and therefore that the economy is weakening? We clearly think we're on the verge of going into a US recession, which without any significant counterbalancing around the world, could be a challenging environment. We are seeing China obviously showing signs of trying to open up again, despite rising COVID cases. So that could be a counterbalance to some degree at the global level. But we believe this is an indicator of weak demand and the challenges ahead for the global economy, and particularly the US economy. So from that perspective, that's why we're still cautious on equities in the coming 3 to 6 months.
Cautious on equities over the next 3 to 6 months. Steve, one final question from my end. Are investors willing to chase India with the Nifty almost at 19,000 and the Sensex well above 63,000?
Well, obviously, India has been the darling, or one of the darlings of Asia this year. So that's clearly been something that's helped. I think, if China does start reopening, so if this experiment works and they can say, okay, despite rising cases, we can ease, then I think the shift is likely to be more towards Northeast Asia and China. Yes, India has had a great year, and we expect it to continue to do well. We're overweight Asia, it's Japan, but maybe it will not outperform like it has done this year.
Okay, all right, Steve. Thanks so much for stopping by and giving us your view on the global, market setup. Maybe, in fact, we're still in a bit of a bear market rally, and as you said, you'll not allocate fresh money to equities at these levels. For the time being, though, we slip into a short break. You come back, we'll focus on the top stocks that we're tracking for you.